And for more on this jobs report and what it holds for the future of the economy, we're joined today by John Herrmann. He's the Director of Interest Rate Strategy at Mitsubishi UFJ Securities. John, thank you so much for being with us here today.
Thank you. It's great to be with you.
So, good news, 203,000 jobs added in November, 7%, lowest unemployment rate in 5 years. Is this smoke and mirrors, or is this really good news?
I think this is a bona fide good report. So, as you're mentioning, just in your introduction, there's a lot of things to cover. There were jobs indicators. There was measures for the unemployment rate. There was an income measure. So lots of topics. But in general, what we saw was this. We saw, as you're saying, a big decline in household unemployment rate. That's very, very important. What we're also seeing is we're seeing payrolls grow significantly. We've been averaging 190,000 for the past 12 months, which is really pretty remarkable. And the other thing, as you mentioned just a few seconds earlier, we did have in the month of October that 0.1 gain in income, but that was a government shutdown month. This month, the gain could be closer to 0.6. So we're seeing a really dramatic reversal. And I think generally the outlook going forward for about the next 7 months, my own forecasts are that we're going to be running about 190 to 200,000 in the private sector. This is really a very good clip here.
So I want to ask you, now the job market has been steadily improving over the last few months. Some are frustrated that it's been improving very slowly or sluggishly. Do you think that the improvement we're seeing in the job market has actually been on trend, or is it really a slow-moving thing?
Okay, so here's, if we looked at this, from a pure math perspective, what we'd see is the economy for the past 32 consecutive months in the private sector has grown jobs at a 2% year-on-year rate. Just for comparison, if we went back the previous decade, we did that for only 12 months. We've done this for 32 months in a row now. So we're really averaging close to about 190 for 32 months. That's really pretty. It's almost 3 years straight and that's a very, very good gain. The Fed's own target was for about 200,000, and we're running the 190. And again, as I'm suggesting to you, is my models are showing that we're going to be sustaining this 190 to 200,000 pace all through next year, even in the event that the Fed does start tapering.
So I want to kind of break down these jobs a little more for our audience. Talk to us about the sectors that added the most jobs in the U.S. for the month of November, and what were the sectors that perhaps added the least jobs?
Okay, well, what we found was this. There were some sectors that did very good. Manufacturing did well this month. We're seeing a big, boom in auto sales, that kind of thing. So manufacturing did well. We saw education at all different levels, whether it was private sector or in the government. Education jobs did well. The healthcare has been a phenomenal sector for the last 30 years. It just continues to be. We also continue to get what we call professional services, management jobs, legal jobs. We saw some jobs in other areas. And then people aren't so flattering when they characterize these things, but we did get, leisure hospitality jobs, or restaurant jobs. We did get retail jobs, and people say, well, these are lower paying jobs. But the fact are, these are jobs, and when you go into a store, the most troublesome thing is when you're trying to buy something and you can't find a sales clerk. So it's actually good that we're adding these kinds of jobs.
Right.
So
it
in
doesn't
general,
really matter whether it's a high-paying job or a low-paying job.
Because it's a very broad and a very diverse economy, and we need all of these jobs. And the thing is, we got what we call a broad-based improvement. So actually, I'm pretty satisfied with this report.
Okay, so you're satisfied. How do you think, this is for consumer confidence, for investor confidence?
Okay, so here's the thing. Consumer confidence, we did get a decent rise after every time the government goes through one of these shutdown things. Consumer confidence is absolutely plummets. So now we're kind of back in the right frame of mind. Energy prices are pretty low in the United States. Gasoline prices are low. So all the equity prices are up. Housing prices are up. So these kind of things are really helping consumer confidence. I think the thing is, when we look back, we do have a very good report. Unemployment rate is still kind of high, and we keep working it down, and we chisel it down, and we're making good progress. But I think the thing is, when we look back last decade or the decade before it, basically the feeling was that if you entered the job market with a pretty decent education and so on, you could basically pick the city you wanted a job in, practically pick the career you wanted a job in, and practically pick the company you wanted to join.
Okay.
And things are just much tougher this decade than those. So it doesn't feel as great as it did in previous. But the thing is, we're on track. And I think in about 3 or 4 years from now, I know it sounds like a long time, but in 3 or 4 years from now, I think we'll get to that stage.
Great. John, Pleasure. Thank you so much for being here today. That was John Herrmann. He's the Director of Interest Rate Strategy at Mitsubishi UFJ Securities.